What is gross domestic product of an economy? GDP is a monetary concept. Final goods versus what we call intermediate goods. In the definition of GDP, if you look at it closely, you will not see that we are concerned with who is producing these final goods and services. What we are concerned with is where are they being produced. These are the three methods of estimating or arriving at or calculating the gross domestic product of an economy. Hello everyone, this is Ranchan Kaul and I'm here with video number 4 in our NCERT series on PW Only as English. Today's lecture will be about national income accounting and we'll start with gross domestic product. Now firstly, what is gross domestic product of an economy? In the last class, we were discussing what do we mean by markets and what can cause market failures. In the events of markets failing, you need an intervention by the government. We are discussing whether a market economy is great for an economy itself, or any government intervention in the economy is good, or when the government intervenes in an economy, it comes out with various policies. Which policies are good for an economy, which policies are bad for an economy? How will we ever know? Or in fact, how will we ever know how big our economy is? The answer to that question lies in the gross domestic product of the economy. Gross domestic product is simply put the level of output produced by an economy. But there is a definition to follow. The definition of gross domestic product is, it is the market value of all final goods and services produced within the domestic territory of an economy in a given time period. The definition may look very simple to read and even understand, but then this definition carries so many implications. There are many words here which have to be looked at. The first, market value. Another, final goods and services. Third is the domestic territory, and fourth is a given time period. Each of these words underlined in the definition carry a certain implication which you will have to understand if you want to be good in understanding what gross domestic product means. Let's begin with the first word, which is market value. When we speak of market value, what implication does it carry? Market value simply means the value or the price at which goods and services are being sold in the market. The implication that this term carries for the definition of GDP is that GDP is a monetary concept, which means consider a simple economy, and if in this economy the only things produced are, let's say, apples and mobile phones. Let's say this economy produces 100 mobile phones in a year and 3,000 apples in a year. We will not say that the GDP of the economy is 3,000 apples and 100 mobile phones. We will have to express the value of GDP of this economy in monetary terms. By monetary terms, what do we mean? We mean if one mobile phone sells at a market price of 1 lakh rupees and one apple, let's say, sells at a market price of 1 rupees, then in that case, the GDP of this economy will be very simply put 100 mobile phones multiplied by their market price, which is 1 lakh, plus 3,000 apples multiplied by their market price, which is rupees 1. This will give us 1 crores plus 3,000 rupees. We will say that the GDP of this economy calculated at market prices is 1 crore 3,000 rupees. We do not express the value of GDP in terms of quantity or in terms of a description of what we produce. We express the value of GDP in money terms. Why do we express it in monetary terms? The reason is very simple. It is far too convenient to do the same. Imagine that economies are far more complicated. They do not just produce apples and mobile phones. Economies produce thousands and millions of products. If we were to explain the GDP of an economy by expressing what this economy produces or how much, it will be very, very inconvenient for us to do that. So firstly, GDP is a monetary concept. Secondly, GDP's value will include only those items which are produced in legitimate or legal markets, which means any illegal production, any contraband, the value of that contraband or the value of that production will not be accounted for in the concept of GDP. For example, in the state of Bihar, there is a prohibition on liquor. There must be many people who in the underground economy produce liquor, sell it and make some money out of it. Will we account for the market prices of those liquor bottles produced illegally? Not in the concept of GDP. These are the two implications of the word market value. The second implication comes from the term final goods and services. Now, what is the implication of this term? When we say final goods, what do we mean? In economics, there is a classification of goods. Final goods versus what we call intermediate goods. Now, the difference between the two, when you just write it down, is very simple to understand. Final goods are those goods which are meant for final use, while intermediate goods are those goods which serve as inputs for further production. Now, although the definition of the two may appear very simple to understand, but it has to be conceptually understood. What's the difference between a final good as well as an intermediate good? The difference you have to remember comes only from one fact, which is in the cycle of production, which good has exited and which good continues to remain active in the cycle of production. Final goods are those goods which have exited the active economic cycle of production, while intermediate goods are those goods which are still active in the cycle of production. What does it mean? It means that over final goods, there will either be no processing, there will be no value addition, there will be no transformation into something else meant to be resold in the market. Either there will be no processing, no value addition, no transformation, or even if there is any processing, any value addition, or any transformation happening, this processing, value addition, or transformation is not happening with the intent of these goods to be resold in the market. While with the intermediate goods, there is a good chance that there will be some processing, there may be some value addition, there may be some transformation, or maybe not. But any value addition, any processing, any transformation, if done to these goods, will be done because these goods have to be further resold in the market. By us transforming them, adding some value to them, or processing them, we are converting them into something else, and that something else is meant for resale in the market. That is what is meant by being active in the cycle of production, which means it has not exited the cycle of production. There is still some more production, some more value addition, some more processing, some more transformation remaining with the intent of these goods to be resold in the market. Intermediate goods will serve as inputs for further production, while final goods are those goods which are meant for final use. Now understand this with a simple example. when Tata produces the Tata Sampann sugar, for Tata, Sampann sugar in itself is its final good. Now, this sugar can be bought by a household. The sugar may even be bought by a cafeteria or a cafe. In the household, you will use this sugar across many items. For example, you may use this sugar to make coffee from it, which means you will add the sugar to your hot coffee and the sugar will get dissolved and will become a part of something else, which is a coffee. But this coffee, is it meant to be resold into the market? No, it's meant for the own consumption by the household, which means that yes, there is some transformation of sugar happening and this sugar gets dissolved into something else, which is called coffee, and it's very hard to separate sugar from coffee itself. But this transformation, this processing was not done with the intent of reselling this coffee in the market. This was done with the intent of final use or finally consuming this coffee by the household. So from the perspective of a household, the same sugar becomes a final good. While if you buy sugar, or if a cafeteria owner buys sugar, he will also convert the sugar and dissolve it in his coffee. This sugar has been processed or it has been transformed. It has been dissolved in the coffee, but this coffee is meant with the intent of resale, which means that sugar has now become a part of something else and this something else is to be sold in the market. This is why from the perspective of a cafeteria owner, sugar is simply an input for further production and this production is meant for resale in the market. So the difference between a final good as well as an intermediate good comes from the perspective of who is buying it and what for. If you are buying it with the intent of transforming, processing or value adding to it, or maybe not, with the intent of reselling it again, then it's an intermediate good. But if you're buying it with the intent of either not processing it, adding no value to it, not transforming it, or even if you do any of those, but you're not doing that with the intent of reselling this item again in the market, then it's a final good. Now, why do we include only final goods and why not intermediate goods? The reason is very simple. The reason is that in the final good, which is the coffee, the cost of this sugar, which was paid by the cafe owner, will automatically be included, which means that if we count the value of sugar and the value of coffee separately, we will be counting the value of sugar twice. This is called double counting. And in the process of estimating GDP of an economy, we do not want to be double counting the value of some item. The value of intermediate goods is already locked into the value of final goods. So if we only take the value of final goods, the value of intermediate goods will automatically be included there. If we take them separately, then we run into the possibility of counting the value of intermediate goods twice. Now, the word is final goods. There is no such thing as a final service. All services are final. Now, what does that mean? It simply means that services have no intermediate stage. Services are consumed the moment they are produced. Ask yourself, can you tell your barber, can you tell your favorite hairdresser, your favorite barber to pack a haircut for you so that you could use that haircut later? If the answer is no, then you understand that all services are final. They are consumed the moment they are produced. For you to get a haircut, you have to be at the barber and the barber has to cut your hair then and there itself. There is no way you can store this service to be used later. This is the reason why in the definition of GDP, we include only final goods and all services. The next term here is all such final goods and services which are produced within the domestic territory of an economy. Now, what is the implication of this term? which is domestic territory of an economy. The implication of this term is that GDP is a territorial concept, which means in the definition of GDP, if you look at it closely, you will not see that we are concerned with who is producing these final goods and services. What we are concerned with is where are they being produced. So long as these final goods and services are being produced within the domestic territory of an economy, we will include their value, irrespective of who is making it. Whether it's our normal residents, whether it's foreigners, we don't care. The only thing we care about is where are these final goods and services being produced. For example, in India, if you go to Rewari, in Rewari, Honda produces cars. Now, Honda is a Japanese company. Any cars produced in Rewari which belongs to India, the value of these cars, should this be included in India's GDP or not? The answer is yes. Even as Honda is a Japanese company, but because it is producing these cars in India within our domestic territory, the value of these cars shall have to be included in India's GDP. Similarly, if you have an Indian company, for example, a TCS, and TCS opens an office in Texas, Houston, US. Any service produced there in Texas, Houston, US will count towards not India's GDP, but it will count towards the GDP of the US. Why? Because this service is being produced there. GDP is a territorial concept. The only thing we care about is where are these final goods and services being produced. We don't ask of ourselves who is producing them. The next implication in here is, now what do we mean by domestic territory? What shall be included within domestic territory of an economy? Obviously, all areas within our political boundary shall be included. And when we say political boundary, we mean our land borders, we mean our coastal borders, and we mean our airspace. Simply means the region over which India exercises its sovereignty, which means the region over which Indian goods, Indian people, Indian money can flow without asking permission of any other country. All these regions which lie well within our political boundary will automatically be included. The second aspect here is we will also include areas which we call net of territorial enclaves. For example, if in Delhi there is a certain region which is occupied by the Chinese embassy, we will consider the Chinese embassy in India as Chinese territory within India. Remember, it is not Chinese territory within India, we will consider it as Chinese territory within India. Similarly, Indian embassy within China will be considered Indian territory in China. So, in the consideration of GDP, any final good or service produced within Chinese embassy in India will belong to China's GDP. Similarly, any final good or service produced within Indian embassy in China will count towards India's GDP. Territorial enclaves include embassies, consulates, scientific bases, military bases, which means our scientific base, our military base, our embassy, our consulates in other countries of the world, we will consider that territory or the area over which we have our consulates, we have our embassies, we have our scientific bases or our military bases, we will consider that territory as Indian territory. Similarly, other countries' scientific base or a military base or an embassy or a consulate in India, that territory we will consider their territory within India. Since GDP is a territorial concept, which means any final good or service produced in what we consider our territories in other countries shall count towards our GDP and vice versa. The third thing which gets included within domestic territory is any aircrafts, any shipping facilities operated by, I wouldn't say domestic residents between two or more countries. For example, if Indigo decides to start a flight connecting Thailand with Portugal, since this is an aircraft carrier operated by our domestic resident, even as this carrier is connecting two different countries, we, for the purposes of calculation of GDP, will consider this towards India's GDP. The fourth part which gets included here is any oil and natural gas vessels or rigs operated by domestic residents in international waters or such other waters over which they have gotten an exclusive right to do so. Which means, consider this, if Reliance gets a contract to, let's say, extract crude oil from Venezuelan waters, since Reliance is a domestic company, because it has acquired an exclusive right to extract crude oil from another country, it will still count towards India's GDP. And the reverse is also true. So, for the purposes of calculation of GDP, when we use the term domestic territory, we are technically not talking simply of our political boundary. What we are talking about is what we call the economic territory of the country, which will include all these regions as I have mentioned. Let's go back to the definition again. It is the market value of all final goods and services produced within the domestic territory of an economy in a given time period. Now, when we say in a given time period, what is the implication of this? When we say that it's a given time period, what we mean is that any production which has happened in a previous time period shall not be counted towards the given time period's GDP. For instance, if we are calculating the GDP of India for the financial year 2025-2026, which will start from the 1st of April 25 till the 31st of March 2026, what we are concerned with is what was the market value of final goods and services produced within this period alone, which means the market value of such goods which are produced in a time period previous to this shall not be counted towards this year's GDP. Why? The reason is very simple, because any production which has happened in a previous time period would have already been counted towards that time period's GDP. One more important thing here is GDP is not the market value of goods and services sold during a time period. It is the market value of final goods and services produced within a time period, which means by default the value of second-hand goods shall also not be counted towards the given time period. One more implication of the same is that this tells you that GDP is not the wealth of an economy. GDP is a flow variable. It has a high correlation with the wealth of an economy, but GDP itself is not the wealth of an economy. Every year, the economy is producing some goods and services. We are only interested in knowing during that year how many final goods and services, or what was the market value of these final goods and services which are produced during that period. Wealth is a stock concept. GDP corresponds to the income of an economy, which is a flow concept, which means we are only interested in knowing the value of final goods and services produced during this time period, corresponding to which people would have generated incomes during that period. GDP itself is not the wealth of an economy, although it may have a decent positive correlation with the wealth of an economy. These are the implications of the term gross domestic product. Once you have understood what is meant by the gross domestic product of an economy, thereafter we will have to understand the various methods of calculating the GDP of an economy. There are three methods of calculating the GDP of an economy. The first method is called the value added method. This is also called the output method, and it is also called the production method. The second method is called the income method, and the third method is called the expenditure method. Understand it well. GDP is the market value of final goods and services produced within the domestic territory of an economy over a certain time period. To calculate the market value of these final goods and services produced within a domestic economy over a time period, there are three methods of arriving at it. Value added method, also called the output method, also called the production method. And the second method is the income method. Third method is the expenditure method, which means we can arrive at the value of these final goods and services produced by simply going to the places of their production. We go to these factories, these firms which produce this output, and we ask of them what was the final goods and services that they produced and what was their market value. Another way of finding the same is by adding the expenditures made by others on the final goods and services produced by this domestic economy over a certain time period. And the third method of estimating the value of final goods and services produced is by adding up the incomes of people which was generated from the production of those final goods and services during a given period. For us to have a good grip on the three methods of calculation of GDP, we have to be a little thorough with what is called circular flow of income. Any economy can be divided into four sectors, and we have to understand the role and importance of each of these four sectors. One sector of the economy we will call households. Another sector of the economy we will call firms. Firms are tasked with the production of output. But for the production of output, firms will require something that we call factors of production. There are 4 factors of production: land, capital, labor, and enterprise or entrepreneurship. These 4 factors of production come together to make the production process possible. Who contributes these factors of production? At the end of the day, each of these factors of production comes from the households themselves. For the firms to produce any output in the form of goods and services, they must require these factors of production. These factors of production are contributed by the households. But no person contributes any of these factors of production without expecting a corresponding return from it. For example, I am contributing my labor to physics wala. Because I am contributing my labor to physics wala, we are able to produce this service which you are enjoying watching this video on YouTube. Now, I did not come here for nothing. For me contributing my labor to physics wala, I am expecting a corresponding return. The return that we are expecting for contributing a factor of production is what we call the income. From the perspective of the firms will have to make corresponding factor payments. The factor payment for land or natural resources is called rent. The factor payment for contributing capital is called interest. The factor payment for contributing labor is called wages, while the factor payment for contributing entrepreneurship is called profits. So understand it well. Households contribute factors of production, which makes production of output possible. These firms, for the contribution of these factors of production, will have to make corresponding factor payments, and these factor payments end up becoming the income of the households. Now, these goods and services have some utility for the end consumers, for the households. The firms will be giving these goods and services to the households only when the households will make a corresponding expenditure on these goods and services. Obviously, since the firms are incurring a lot of costs to make this output, they would want to recover this cost alongside some profit margin, which means that these goods and services will not be provided by the firms to the households for free. These goods and services will be provided by the firms to the households in expectation of the households making an expenditure on these goods and services. The money for this expenditure primarily should come from the incomes that the households have generated for contributing factors of production. Households in an economy are primarily tasked with what is called consumption, which means that the expenditure that they have made on these goods and services shall be called consumption expenditure. The circular flow of income simply says that one person's expenditure becomes another person's income. The expenditure made by households comes together as revenue to these firms, and from this revenue the firms pay out factor payments which become the income of the households. The expenditure of households becomes the income of the firms. The expenditure of the firms becomes the income of the households. Now, this is a two-sector economy. You add to these two sectors what we call the government. I don't know, something has happened here. Okay, let me just try to use a different colored pen. In any economy, you will also find there is a role of the government. Now, what does government do? Government, from an economic standpoint, taxes people. Why does it tax people? We are discussing this in the last class that when the markets fail, the governments have to intervene. For example, the markets fail in the provision of public goods. Now, somebody has to produce these public goods. It is the government which we expect to be producing these public goods. But for the production of public goods, the government also will require some money. Where is this money going to come from? The government is going to collect taxes from people. Not just will it tax people, it will also tax these firms. In addition to asking for taxes from the people and from the firms, the government sometimes also gives subsidies, not just to people, but also to the firms. If you have heard of something called an LPG subsidy, this is part of the payment that the government pays on behalf of people who should have otherwise been paying a market price. The government takes away taxes from you, but sometimes also gives you subsidies. So net, it collects what is called taxes minus subsidies. This is what we call net tax payments. It collects some net tax from the households. It collects some net tax from the firms also. Now, this tax money is spent by the government. Firstly, this tax money will be spent by the government in providing compensation to the people who comprise to form the government. At the end of the day, the government, which will include your legislators, which will include your parliamentarians, which will include the judiciary, will include the executive also, all of these are people and they belong to some household. So from the tax money, the government has to pay compensation to these people. Similarly, the government also has to produce public goods. The government has to create what is called public provisioning. That also requires money. For instance, think about the government deciding to set up a public hospital. Now, the public hospital will require tons of cement, it will require so many bricks, it will require X-ray machines, CT scanners, MRI scanners, right? In addition to the people who work there. How many of these items are produced by the government itself? The answer is none. Which means for public provisioning, the government will buy goods and services from the firms and in lieu of this will make an expenditure to the firms. This expenditure is going to be called government's expenditure. In addition to the government as a sector, there is also the fourth sector which we call the external sector. The external sector, simply put, is the rest of the world, which means the output produced by the rest of the world sometimes gets imported by the domestic economy. Sometimes the output produced by this domestic economy gets exported to the rest of the world. Exports and imports. Some members of the households, they provide factors of production they produce in the rest of the world. Corresponding to them providing these factors of production, they receive factor payments which will add to the income of these households. Any economy can have four sectors. If it's an open economy, the four sectors would be households, the primary task of which would be consumption. Firms, the primary task of which would be what we call production of output. Government, the primary task of which would be, from an economic perspective, public provisioning. And the external sector, which sometimes supplies output to an economy, sometimes also imports output from an economy. This is what a general economy is structured like, into four sectors, which means any output produced by the firms in the form of final goods and services can either be bought by the government or can be bought by the households or can be bought by other countries or can be bought by other firms. How can an output of one firm be bought by another firm? We just discussed intermediate goods. For example, there will be a company that produces steel. Steel would be used by companies which make bikes. Steel would be used by companies which are construction companies. Steel would be used by companies which make automobiles. That means production of one firm can also serve as an input for another firm. Similarly, some firms produce what we call capital goods. Capital goods being such physical objects which contribute towards production, which add to the productive capacity of any firm. For instance, the buildings where these people sit. For instance, machines, tools, and implements that firms normally use for production purposes. For example, this shirt was bought from Uniqlo. Now, Uniqlo is an apparel manufacturing company, but there will be many power looms within that company or within their factory premises more specifically. Do you think Uniqlo itself produces those machines? The answer is a clear no. When you look around and you look at various companies and their offices, if you go to Gurgaon, you'll find the office of Airtel in the middle. Do you think Airtel produced that building? There was a construction firm which produced that building for Airtel, which means the output of firms can also be consumed by other firms. When capital goods produced by some firms are bought by other firms, these capital goods have a tendency of increasing the productive capacity of other firms. This kind of expenditure made by firms on the output produced by other firms is going to be called investment expenditure, which means that over the output produced by the firms, some of these output is meant to be used by consumers. We will call them consumer goods and services. Some of the output produced by firms such as machines, tools, implements, buildings, this output is used by other firms to add to their productive capacity. This kind of goods we call capital goods. Of all the goods and services produced by firms, some goods and services will be meant for use by end consumers, while some will be meant for use by other firms. Which means if you think about the output of an economy, who can really make an expenditure on this output? This expenditure can come from the government, it can come from the side of the households, it can come from the side of the external sector, it can even come from other firms. In the calculation of GDP, in the production method, we can simply go to these firms and ask of them how much was the market value of your output produced. To arrive at the market value of output produced by these firms in a given time period, we can take an indirect route also, which is where we are going to be asking each of these four sectors how much was the expenditure that they made on the output produced by other firms during this time period. The expenditure made by firms, by government, by households or consumers, and by the external sector. There is a third method of arriving at the value of final goods and services itself, which is called the income method, where we ask these firms how much did you distribute factor payments to your factors of production? What were the incomes which you distributed for the production of goods and services, final goods and services during this time period? That method is called the income method. These are the three methods of estimating or arriving at or calculating the gross domestic product of an economy. We'll throw some more light on it in the next video, and then we'll also discuss further more concepts of what is called real and nominal GDP and what we mean by economic growth and the limitations of GDP therein. Till then, see you. Thank you.